Welcome, ladies and gentlemen, to Commodity TV and a new edition of our online interview series. We want to talk today, long time ago, with Corey Diaz, the CEO of Anfield Energy. Hey, good morning to Canada. How are you, Corey?
Good morning. How are you? We're well over here. Thank you.
Super, perfect. Same here, despite we had some snow today. I can't believe it. But it is what it is, end of April, yeah. It looks like the global warming is waiting a bit. Anyhow, Anfield Energy, you are in the uranium vanadium space. Please give us shortly an idea of the company.
Sure. So we are a uranium vanadium company that has all of its assets in the U.S. We're focused on the conventional side of the business. Our aim is to build this conventional mine and mill complex underpinned by our Shooting Canyon mill, which is one of only 3 licensed, permitted, and constructed mills in the U.S.
Okay, super. So that looks like you have survived, obviously, the downturn in uranium. That is important, I would say, because uranium is back on track and really hot. And I saw a very familiar name in your presentation, Uranium Energy Corporation. So you bought the Slick Rock project from them, and they will be, I think one of your largest, or even the largest shareholder then. Can you comment a bit on that, please? What is the transaction? You have a $12 million capital raise.
Sure. So, I think this is a transformational event for the company. So we've done 2 different things as part of the transaction. The first thing, as you mentioned, was a debt settlement. So through our 2 transactions with Uranium One, we ended up with roughly $18 million worth of debt. Uranium One sold its assets to UEC late last year, and part of that sale included the debt obligation that we held with Uranium One. So we've been negotiating with UEC over the past few months to determine a way to remove that debt from our balance sheet. And through negotiations, we constructed a deal whereby we've settled the debt through $9 million worth of Anfield shares to UEC and $9 million in cash to UEC. And the financing that we've done from $12 million, actually, it's been increased to $15 million because of the interest in the financing.
Nice.
We'll be using the proceeds of that financing to pay the $9 million to UEC. So we've settled the debt through that combination of shares and debt, shares and cash. The second part of the transaction with UEC relates to an asset swap. So we've taken our Wyoming portfolio of ISR properties and traded it with UEC for its Slick Rock conventional asset in Colorado, which sits next to our West Slope properties. So we're essentially trading the same number of uranium pounds, and we're receiving roughly 70 million pounds of vanadium on top of what we're getting in uranium pounds. So it fits our strategy of focusing on the conventional side of our business, underpinned by our mill. Our view is that it's so important in this current environment to own the production facility that you're using in order to process material. And so us swapping out the ISR properties over which we had no production control, our plan was to work with Uranium One to process. We are now fully focused on our own processing facility in Utah.
Super. So how does that processing facility look like? Is it, let's say, do you have to invest a lot of money into that? How fast can you go in production with that? Give us an idea.
Sure. So, it's probably going to cost about $25 to $30 million to refurbish the mill. So it's constructed and so standing. So it's not a brownfield property or actually it is a brownfield property. It's not a greenfield property. So this means that it takes a very little bit of money in order to get it up and running. So in comparison to build a new mill, it's going to cost you about $150 to $200 million and probably takes a long time to get all the approvals in place to construct a mill. For us, it's going to take about 2 years working with the state of Utah in order to push that asset forward. And that's kind of always been our plan. All of our assets are brownfield properties, so we're not going out there drilling to try to find a resource or delineate a resource. There's a historic resource in place, or someone has produced from that property before, or there's a current resource in place. So we've advanced the assets. We use advanced assets to move as close to production as we can in the relative near term. So our aim is to be in production within the next 24 months.
Okay, super. So the mill refurbishment, approximately $25 million. What is in addition needed to bring you into uranium production? Because this world needs a lot of uranium in the next years.
Yeah, so that's the, and finally we have what's called Velvet Wood, which is another uranium vanadium project in Utah that would probably take roughly $5 million to get up and running. So it's a relative low cost to get production started collectively at all these properties, and certainly our aim is to have material on the ground by the time the mill is ready to accept it.
Super. So we talk about, if my mathematics is correct, about, let's say, if we calculate it on a bigger side, like $70 million probably.
70, sorry?
Yeah, 70.
Yeah, so we're, if we're looking at 9 to 10 West Slope, if we're looking 20 at Slick Rock, and then another
25 for the mill.
So yeah, so 60-ish if you're doing them all at once. So
yeah,
I guess the plan here too is to start the mines up, but as the mines get restarted, the revenue generated from production would also cover those costs. So we wouldn't have to spend $60 million up front.
Okay, super. So what is the share, let's say, between uranium and vanadium then in the future? Because vanadium is also something, which I see very positive as a metal.
I agree. And our Colorado properties are essentially vanadium mines with some uranium in them, as opposed to the opposite, the normal opposite. So we're talking 5 to 6 times vanadium for every part of uranium. So they're significant vanadium mines. So there's a huge opportunity for us when it comes to producing out of those mines. And in terms of the value of the rock today is anywhere between $450 to $500 per ton, which means that we can ship that material to our mill, preliminary costs of anywhere between $200 to $250 for mining, transportation, and milling, means that there's a significant margin available to us at today's commodity price. So we're very happy to start moving forward on those assets and keen to move forward on those assets to get those into production.
Okay, fantastic. Do you have to, let's say, build something separate to process the vanadium also? Meaning, because you have all in one rock, I would say, yeah? So then you have to bring it out. And do you have to do something in addition, or can you, let's say, can you toll mill the vanadium? How does that work?
So we would look to build a vanadium circuit, so add a vanadium circuit to our mill. The cost to build a new circuit would be about $10 to $15 million. So, and we've looked into it already, but if we have roughly 120 million pounds of vanadium, the largest in situ vanadium resource of any uranium story out there, the cost of $10 to $50 million is pretty minimal considering the return we would get from processing that vanadium. So
okay, super. So I saw also in your presentation you are consolidating the assets and the debt elimination. We spoke already about it. So what are your next plans with all the assets? What is the game plan until the end of the year?
So our aim now is to fast forward everything related to production. So we're going to advance the assets as close to production as we can this year. So for example, at the West Slope, we put out a resource estimate for 4 of the 9 mines probably 2 to 3 weeks ago. Our aim is to put economics on those 4 mines, so a PEA, and then look to build out resources for the other 5. And then ultimately down the road put out PEAs for those 2. So we have an understanding of the economics for West Slope itself. We're also going to do the same for Slick Rock. Obviously, we just acquired the asset. We've got some work to do there to determine what information is available to us, what information may be missing in terms of being able to get economics on that project here. There's a historic PEA, but we certainly have to do work ourselves in order to confirm that PEA. So, and then thirdly, for Velvet, we do have a PEA from 2016. We may look to update that resource and that PEA, and ultimately create a global PEA for all of our projects in order to understand what are the real economics available to us by mining all of these properties through the mill. And while we're doing all those things on the mining side, on the milling side, we'll be advancing our current license at the mill from standby to production ready status. So that's so we're going to be working. We've got a lot of balls in the air, but the ultimate aim here is to get into the position where we can mine, in the next 18 months and have material available on the ground so when we do turn on the mill, we can just start a constant flow of material going from those mines to the mill.
Okay, super. And yeah, let's put it that way. How do you see today's uranium price? Because we had a little bit of a shot in the foot, I would say, from 63 down to 53 because of, I think it was Anglo American and Rio Tinto, some numbers disappointed and stuff like this. It's what I read between the lines, but honestly, that makes not really sense to me. But okay, it is what it is. But what would be for you the incentive price to go in production?
And we can create a margin that's comfortable enough for us to move forward into production. So that's the first thing. But we don't think the price is going to stay down in the 50s anyway. We certainly think it's going to go higher, and we'll be looking to sign contracts higher as we move forward. So I think that's that's kind of the key here.
And how many pounds do you think you can produce? I know it's hypothetical, also for the regulators, forward-looking statement. But what could be a realistic plan for you?
So we can produce 750 tons per day. Nameplate capacity at the mill is 1 million pounds per year. So the regulators limit us to 1 million pounds per year, but that is on the current license. So our aim is to get the current license in place and put it in a position to produce, and then we can start having discussions as to how many more pounds we can put through it, because we have between 25 and 30 million pounds of uranium available to us through our current mines. So we could certainly look to increase capacity to produce more and still have a long-term production profile within our portfolio.
Absolutely. I could imagine you have also longer-term exploration potential.
We do have exploration protection, but certainly our aim is to focus on the things that are readily available to us, and then as we go forward, we'll look to see what else is available to us through exploration.
Absolutely. And I mean, if I look at the US, 55 million pounds consumed, almost zero production. So I think the US is desperate for domestic production, right?
Absolutely. I absolutely agree. I think we have a unique opportunity here. There are only a handful of potential producers in the US, of which we are one. And I think that when it comes to securing contracts for long-term pricing, greenfield projects, unfortunately, will not be part of the mix. So there are a lot of exploration stories, but unfortunately for this cycle, I think the utilities will be focused on those companies that can produce in the near term and provide material that they need in the relative near term.
Yeah, absolutely. Super. Last question regarding your equity structure and also, let's say, call it cash and your share structure. I mean, 16% with UEC, that is a no-brainer. That is fantastic to have UEC as a shareholder. But as you said it already, I think 625 million shares will be outstanding after the financing. So you probably will do a rollback, I could imagine.
Yes, we're going to do a rollback on a 10-for-1 basis. We think that, in conjunction with this transformational event, it makes the most sense to do it at this point. It gives us some flexibility in terms of financings going forward, but it also gives us the opportunity to potentially look at listing on a different exchange or a more senior exchange, whether it's in Canada or the US.
Okay, super. And who are your other shareholders? What has management shares?
So management and insiders hold probably about 7%, 6 to 7% post financing. So there's relative interest here, and certainly with inside, and we tend to most directors or insiders tend to participate in rounds of financing. So that's another appealing position when it comes to our board of directors. Everybody wants to remain involved.
And after all the transactions, what is then cash in the bank for the rest of the year, approximately?
After paying out UEC, et cetera, we'll probably be sitting at about $7 to $8 million.
So, but that will be enough for the year and to really rock all those things you have just described.
Absolutely. There's enough there for us. Certainly, we'll always be opportunistic. If the stock does have a significant lift, then we'll look at what our opportunities are at that time. Certainly, we know that we'd be happy to raise money at higher levels as opposed to raising here. But I think we have plenty of money in the till to do what we need to do in the relative near term. So.
Super. That was a great final sentence. Corey, thank you very much for the interview. I'm a happy shareholder, honestly. I really like what I heard today. That is fantastic. Hopefully within the next 18 to 24 months, there will be then in production back. That looks all great. UEC as the main shareholder here with 16%. That is fantastic to have a partner like them. They did a nice project swap, which is also great because they do conventional mining. UEC is doing ISR, so it makes absolutely sense to do swaps like this. And one thing is really for sure, the US needs a lot of domestic uranium production because they have almost nothing these days. And we all know what is going on in the world. So uranium is poised to rise. Anfield looks great. They have done their homework now. They have the debt eliminated, $7 to $8 million still in the bank until the year end. They are financed. I would suggest you really have a look on Anfield Energy. Thanks for watching us. I'm a shareholder of the company. Bye-bye from Switzerland.